record, yeah. Okay.
Yes, it is.
Hi, Steve.
Hi, how you doing?
Good, how are you?
I'm good.
Thanks for joining us.
You're welcome.
Tia, dear, you coming? Okay.
And then Luke, just make sure you manage the audio, so this way,
Okay.
we mute everyone. Because that Bill Fernaro, he's always making noise all the time, right?
I'm
Bill?
not.
Hello,
I'm waving.
how are you? Nice to see you.
Thank you.
Except I'm gonna push the mute all button. So if you guys just want to unmute when I push it.
Yeah, but don't do that because then you'll mute John and me.
Yeah.
So you gotta really do it individually. Unless you do it now real quick but I always get nervous because a couple of times I've done it that way and you can't unmute the speakers. Sometimes it's a little temperamental, so I always do it individually because I don't trust the Zoom.
I would see.
These are like little things along the way that happens. Can you see where to mute it?
Yeah, I'm muting.
Yeah, right. Okay, we're at 101. Do you see more people coming in, Luke?
I just let in 2. So we're at 21 right now.
Okay. John, do you want to start? And then Luke, just, be, conscious of people coming in.
Mm-hmm.
Because we'll do the intro, and by the time they come in, then they should miss the session. Okay.
Mhm.
Okay. So we're going to start. Welcome, everyone. This is the St. John's University Power Hour series, hosted by the McAllen Society, which is our legacy society. My name is Susan Damiani, and I am the Director of Gift Planning and the McAllen Society for St. John's University. I am thrilled to have back one of our resident Power Hour speakers, John Ceparano. John is a graduate of St. John's, 1985, from the College of Business Administration. We went to school together. I always let everyone know that, yes, he was the St. John's cheerleader back in the day. And we're just so happy that he's back with St. John's, very supportive of St. John's, and he shares his expertise when he's available. And today was one of those days, and we're so happy. He is a principal at Modera Wealth Management. The main office is located, am I correct, in Tampa, Florida, John?
Well, no, there's really no
sorry.
main office. We have
Okay.
a New York City and New Jersey office, which is right by, not that far from the campus in the city there. But we have offices up and down the East Coast.
Okay.
You can always look that up later on if you'd like, and they'll share the information.
What I love about John, he's a financial advisor, an independent financial advisor, and also a CPA, which I think is great because, it can help you with your taxes, but also help you put together a really solid financial plan. There's some new things that have come on the table based on the legislation that was passed by President Biden at the end of December. So we thought it would be important to share that with you. So today our topic is tax saving opportunities and what you need to know now. So I'm going to turn it over to our expert financial advisor, John Ceparano. Thanks, John.
Thanks, Susan. It's always fun to be back and try to impart some knowledge that I picked up along the way, and things keep changing all the time. My background started with Pricewaterhouse as a CPA, and there's nobody that I know that doesn't want to have to pay any more than their fair share of taxes. So it's been a lifelong quest to keep up with this stuff because laws keep changing, administrations change, and we get into it. Over the years, I worked in Manhattan at Pricewaterhouse, like I said, and then I moved down to Florida, but I have offices up and down the East Coast, which I come back and see all my clients. So when I come up and see Susan, I'm usually seeing another 5 or 10 clients in the local area. They're also served by my local office in Manhattan or New Jersey. But anyway, today, what I like to do is keep everybody on top of how their investments and tax savings are integrated, and knowing what opportunities there are out there to minimize your taxes, either as a retiree or a working person. I'm sure there may be one or both of you on the phone. I can see some pictures. So we're going to go over that, and then also give you some tax tips if you haven't filed your tax return yet. And some of these tax tips are ongoing and what I call evergreen, the things that you can do from year to year. But we'll talk about specific ones right now related to some new laws that came out. So if you could go to the next slide. Oh, this is just a little bit about our background. We're a fee-only firm, just so you understand who I'm talking from. We don't have commissions or anything like that. We have to put our clients' best interest first. There's no commissions, no extra fees. The only people that pay us are our clients directly. So we're always looking out for the best interest. I've been doing this for about 30 years. We've got over 53 CFPs that work for me. I'm one of the principals of the firm, one of the original 8 founders in our business. And we help people all over the country. If you can go to the next slide. Let's get right into it. So the questions that we're going to deal here is what's new. Well, the Secure Act 2.0 passed at the end of December, like Susan said, and its goal was to enhance or bolster retirement readiness. A lot of people go into retirement and they are not ready for it, haven't saved enough, or worse, they've gone into retirement and don't understand what the tax consequences are of some of their decisions, such as like taking the pension or taking a full pension, on whether or not their spouse should be a beneficiary later on, where they get 50% or 75 or 100% of their pension. And in many cases, they make these elections, but don't have other resources for when they pass away for their remaining spouse to get any benefit. So there are things that we'll be talking about. I'll be coming back. Susan asked me every 3 or 4 months to come on and go over various different planning topics. Right now, with tax season upon us, we wanted to touch on these. There is another part to this right here regarding retirees. If you can just hit next on this, maybe the hourglass, yeah, the highlights, if you can keep going. So for retirees, one of the first things that just changed here, the new starting age for required minimum distributions has increased. It's gone from age, if you click on one more, from in 2023, from age 72 to now age 73. So if you're in that time frame, you do not, and you're not 73 yet, okay, you do not need to be taking a required minimum distribution, and that means that you can let your retirement accounts continue to grow unless you need some money from it. And going forward, if you click once more, Luke, yeah, go back one. In 2033, 10 years from now, some of you say, I don't even know if I'm going to be around, but in 2033, they're making it go to 75. So if you're older right now and you're past this age, this is actually going to impact your children if you have children. So this is all related to people living longer. So what you need to know now is, depending on what your age is, you either had to start this already. If you were already 72 prior to this year, you're already doing this, you need to continue taking it. If you haven't hit 73 this year yet, you've got more time to start. Okay, next slide. And by the way, if anybody has any questions, please, raise your hand, unmute yourself, and I'll be glad to answer questions as we go along, because I want this to be more like a fireside chat kind of thing. Retirees. So how the new RMD age 73 could impact you. Well, you get another year to consider Roth IRA conversions. You may say, what is a Roth IRA conversion? Well, money that's in your IRAs or still in 401k plans, if you have not moved them from your old company's 401k plan into your IRAs, you can. And at that point, then you can do what's called a Roth conversion. That means take money out of your IRA and put it into a Roth IRA. IRAs are considered tax deferred. That means while they are in the IRA, you're not paying any taxes. But when you have to start taking your required minimum amount, which is a percentage over your lifetime, remaining lifetime, and there's tables for this, you have to start taking it out starting this year at age 73. Before age 73, it gives you another opportunity before your taxes go up because of this new income showing up on your tax return from the IRA distributions that are required. You can start doing some Roth conversions, especially if you're in your 60s or early 70s, so that you can move that money over now at probably a lower tax bracket, or to make sure that when you have to start taking your required minimum distributions at age 73, it doesn't force you into a higher tax bracket. It's something that your tax preparer or your financial advisor should be talking to you about if they haven't already. And you could still do it if you're in a lower tax bracket. And currently, at least until 2026, as of right now, there is a 10% bracket, 12%, then it jumps to 22, goes to 24%, and then jumps up to 32 and higher. So while you're in that 22% less bracket, or even 24%, so you don't jump onto these higher brackets later when you have to start taking these required minimum distributions, it can help you save taxes during your lifetime. And if you're leaving this, so to speak, to your children, not charities, but if you're leaving it to your children, then it will ensure that they have tax-free distributions out of a Roth when they get it. And it will last for 10 years after you die, that they do not have to take any distributions. And when they take money out of that Roth that they inherit, they will not pay taxes either, but they have to take it out of there by the end of the 10th year. And then they can decide what to do with it, either spend it or invest it somewhere else. In this additional year, second point here, your adjusted gross income could lower your tax on Social Security. So because they extended it at age 73, for those of you who are under age 73, your Social Security is taxed based on your other sources of income that's on your tax return. If you can keep your sources of income on your tax returns lower, it can lower the portion of your Social Security that are taxed. For those of you who are in higher income tax brackets, it could bring you down below certain thresholds that will force you to pay higher Medicare premiums. So there's a number of reasons why the government extending this from age 72 to 73 will give people one extra year to keep their taxes down. And in later years, like I already said, if you could do some of these potential Roth conversions, or just not take anything right now for that 1 year, you could be pushed into higher tax brackets. So these are some of the things that are important, or the consequences of them raising the minimum age bracket. We have to start taking required minimum distributions. Does anybody have any questions? Okay, let's go on to the next slide.
Wait, John, sorry. I think Steve just made a comment about the RMD and the penalty. Do you see that in the chat?
No, I can't see it. If you could read it to me, that'd be great, and I'll help make a comment if it's necessary.
Yeah, sure. He said penalty for missing an RMD reduced from 50% to 25%.
Yes, yes. There are other penalties there. But if you're doing a really good job and you're working with either a financial planner or a CPA, that should never happen. Penalties are only because people are not aware of what their requirements are. And I don't have any clients that have ever paid a penalty. So hopefully you're working with somebody that's keeping you on top of that, or at least you're aware of it. This is how professionals, can be valuable, and make sure you don't have those penalties, because you can't get around those penalties if you miss them. There's rare exceptions. So Steve, whoever brought that up.
That was Steve. Yeah, I have another comment. If I convert today to a Roth, what taxes are due at the time of the conversion?
It's during the tax year in which you make the conversion, because what you're doing is basically taking an IRA distribution out and putting it into a Roth. So that money gets added, whatever you take out to do a Roth conversion, it gets added to your tax return along with your other sources of income. And then based on whatever tax bracket you're in, that's the percentage that you would have to pay. So if you're in the 12% bracket and took out $10,000 and it remained in the 12% bracket, it would cost you an extra $1,200. If you were in the 22% bracket and took out $10,000, it would cost you an extra $2,200. So it depends on what bracket you're in. Okay. All right, good questions.
Yeah, good questions.
Yep. The next thing for retirees, for the charitably inclined, which has been labeled as the Legacy IRA, there's an opportunity now to make a one-time QCD, which is called a qualified charitable distribution. What that means is you can do this up to $50,000 a year. Okay. And if you can click down, there's 2 more lines on there. Right. So let's just stop there for a second. Okay. You can make a one-time up to, you don't have to do 50,000. Now everybody wants to do that, but you can make up to a one-time $50,000 distribution out of your IRA. And that has to go directly to the charity. Now, in this case, it's either a charitable remainder trust or a charitable gift annuity. And it can only contain IRA assets. This can't be mixed in with contributions from like a taxable account. It has to only be set up this way. And this is easy to set up and do with a your financial advisor. And what a charitable remainder trust and a gift annuity basically do is says, you're going to give this money, the $50,000, the principal will stay in that account, that trust. And while you're alive, it will distribute out the income from that trust while you're alive because you need that income. When you pass away, the charity gets the money and uses it for its causes. So that's what you're able to do. And you're able to now do this for up to $50,000 in 1 year. You can't spread this out over numerous years as the law is written right now. So you can't do 25 this year and 25 next year. They're doing this as a one-time big provision to either you want to do this and you don't want to wait until later years or when you pass away, or you happen to have a big income year where you sold something, a piece of real estate, or you just or some kind of big income item hit your tax return. This is a way to offset that and reduce your taxes. Or in one particular year, if you're in the 22, 24, or 32% bracket and you want to get it down dramatically and reduce your taxes, you can do up to $50,000. You don't have to do 50, you can do 10, 20, 30, 40, 50, whatever you want. But it has to all be done in 1 calendar year. Now, if you
Can I
click
just
on
add
one,
to that, John? Let me just add before you change the screen, Luke. One thing just to know, there's many nonprofits like St. John's. To establish a charitable remainder trust, the minimum is $250,000. There are nonprofits that would do a trust. I don't know. There has to be very few that would do a trust at 50. However, if a spouse, they both can do it together, right? 50 and 50. Then if you wanted to establish a trust at St. John's for 100,000, I believe St. John's would probably make that provision, for the fact that this is a one-time QCD. The charitable gift annuity for St. John's, the minimum is $10,000. Just anybody.
Just what I've already dealt with a number of clients is this. Some of them, not everybody can do this or wants to do this, but the ones that do want to do this, and a husband and wife putting in the 100 or something even a little bit less, but really want to get a jump start, they can do this. Now, because they probably still have money in the IRA beyond putting this amount in there, they can continue. And I see charitable organizations such as St. John's say, well, if you commit to putting in so much over the next 5 or 10 years on top of this, okay, then you can get up to that 200 minimum, just as long as they see a commitment. And then what you're doing is you're also reducing your taxable income each year because this is still a qualified charitable distribution. So the following year, let's just say you want to give another 10,000, you want to do that for 10 years. On top of this, you'll be up to 150. Plus, wherever the money is inside of this trust is also invested and growing. So we could talk about that another day, but there's ways to work with the charitable organizations, which is what this new legislation came out with to be
And
able.
if I can just add one more thing about charitable gift annuity, because I don't know if everyone knows what minimums and so forth. The annuity at St. John's is a minimum of 10,000, but also it's not your traditional gift annuity. So normally in a traditional gift annuity, you would get a charitable tax deduction, and the ordinary income would not be taxed right away. With this charitable gift annuity, you're getting the income tax benefit, but you won't get the charitable tax deduction, and the ordinary income would be taxed right away. However, something to think about, if you're rolling this money over into annuity, just the other day, I think I ran an annuity for someone in their mid to late 70s, and the rate was, almost a high 7 or close to 8%. So where are you getting that for your money, right? So it is a pretty good deal.
Yeah, it depends on your circumstances.
And just circumstances, exactly.
Yep.
All right,
Look,
thank you.
just click.
Sorry to interrupt.
No, that's okay. Click. This is Fireside Chat. Everybody can join. One other thing I want you to know is that the $100,000 qualified charitable distribution annual per taxpayer cap is now slated to be indexed for inflation. So there are a few clients of mine that give away a lot of money. Not everybody could do this because their IRA is not that big, but I do have a few that do this. And this, because their wealth has grown substantially over the last 10 years or so. This is now being indexed for inflation, so you can do even more. Not most people can't do that much, but I just want to put that out there.
John,
Next.
we also have from somebody, sorry to interrupt again. Can a
Sure.
QCD be an RMD be made in Q1 2023 and count for the 2022 tax return?
The charitable distribution, this is not like an IRA or anything, has to be done in the year by 12/31, the QCDs. It's a calendar year based thing. So you can't do anything now in 2023 for 2022.
Okay, thanks.
It's calendar year. Okay, next slide. Okay. This one here is, click on it one more time. For some reason we're not getting everything on there. Okay, there we go. All right. This is for the people that are still currently working. And I have a number of clients that are still working and they're in their 60s, 70s, and 80s. So this isn't just for young people, although we got a picture up here with kids. But even if it was, you have children, these are things that you can make them aware of. The increased Roth availability. There have been certain restrictions up until 2023 where people couldn't put money into a Roth IRA. So typically what I advise people, not retirees I'm talking about, but working people, is that if you're in a low tax bracket in your 20s or something like that, you really want to put money into Roth IRAs, because as your career progresses, you're going to be going into and making more money. You're going to be in higher tax brackets. So when you're in your early working years, you may want to do a Roth. But using today's tax brackets, when you start to get into the 22, 24% or higher, it makes sense to do traditional deductions. So the transfer, what they allowed now is that you're allowed to have transfers allowed from your Section 529 accounts, which are college prepaid, plans, and you can move it over to Roth IRAs beginning in 2024, next year. So for example, if you set up 529 accounts, which are college funding accounts for higher education, and that's actually a misnomer, because now you can use 529 accounts, even kids in kindergarten through, trade schools or through college and so forth. And they're very liberal on what those expenses can be for tuition, for fees, for laptops, for whatever. But sometimes people have overfunded these things, and that comes from kids getting scholarships. So if they overfunded these 529 accounts and the kids did not need them to get through college or whatever their education expenses were, they can now roll this money over into a Roth IRA, but it's limited. I think if you click one more item here. Nope, go. Yeah. Anyway, you can roll money over into a Roth. And they also increased the 401k simple IRA catch-up contributions beginning in 2025. That's in 2 years from now. So we can help people get caught up a lot quicker, because some people, you're going through life, you get married, you have children, maybe you have school debt, maybe you started a business, you took a loan out for that too. You maybe have a mortgage. By the time you're able to start putting more money into your IRAs, you may not be into your 40s or your 50s. And some of these people are going, oh my God, how am I ever going to retire if I can't put more money away and save on taxes? So what they're doing is creating opportunities for people to catch up by being able to put more money in. Instead of $7,500 a year, it's going to jump to over $11,000 in 2025. So these are things, if you're not working, please make your children aware. And your children, if you're not working and you're retired, they could be in their 40s now or 50s. And if they're not, talking to their CPA or their accountant, may not be aware of these things. So please make them aware of that. Return to the next slide. Yeah. So let's go into this a little bit deeper. This is for people currently working. The Roth simple IRAs and Roth SEP IRAs are now available. They weren't available previously. And these are retirement accounts. And 401k plan employer contributions are now Roth eligible, which means that the employers can put money into Roths for their employees if they so choose. And in 2024, you don't have to remember all this. We can always make this available to you. The catch-up 401k contributions for employees making over $145,000 must go into 401k plan Roth accounts. Okay, so if they're having contributions by their employers into their accounts, they now need to go into their Roth accounts. There's two benefits for that. For the employee, okay, it's a benefit of having tax exempt income being made for the rest of their life. From the employee standpoint, though, that money going into there is still going to be taxed, okay? So they don't get the tax benefit, but if they're doing it early in life, they can have this growing asset for the rest of their life. And then ultimately, if they don't use it all up, to the children's tax-free. That's wonderful. And 401k plan participants will not be required to take RMDs. Currently, they're required from their Roths. So that means if they continue to work, into the 60s or 70s, they can continue to keep this money in and they're not going to be required to take money out. So this is an opportunity for people to utilize some of these investment vehicles if they're still working. If anybody has any questions in this, because it's not always easy to absorb this in a short presentation, please send it to my email address, which I will share with you at the end. And I'll be glad to help you out or get it. You can pass it on to your children. Next slide. Okay. How these changes could impact you. It's an opportunity to increase Roth contributions. It's an alignment of the Roth 401k plan with their Roth RMD rules, which will eliminate the need to roll over 401k plans to Roth IRA accounts. Some of you may have worked with some financial planners, or maybe you haven't, but I want to make you aware of this. You can't do a Roth conversion out of a 401k plan previously. You had to move it out of your company's 401k plan, move it into a self-directed IRA, and then do the conversion. This makes it so much easier. You can take it right out of your 401k plan, just like you have to take it out of your IRA. Previously took it out of your IRA to put it into a Roth. Makes it easier. There's less extra work to do. And higher wage earners will now be unable to make tax-deductible catch-up contributions, which I just stated previously, because they can only put it into Roth accounts, which are non-deductible. Any questions right now, Susan?
No.
Okay, go to the next slide. Okay, so this is just a summary about the 529 plans. they're allowed from the 529 plan to Roth IRAs beginning in 24. And they have an annual contribution limit, and they're just subject to the same, contribution limits. And they have a $35,000 lifetime limit. So that's how much money could be rolled over from these college plans. This may reduce, people going, how much money should I put in for my child or my grandson or granddaughter? This will reduce the concern of accumulating too much money, because I've had a lot of people, oh, the college is going to cost, $50,000, $100,000, $200,000. So I need to save all this so they don't have to come out with any loans. Well, depending on how much you can afford in the first place is the primary question. But assuming that you decided you wanted to put in enough to give them so much per year, $10,000, $20,000 for college year, if they wind up getting scholarships and don't need it, then you can roll it over into a Roth account, and then they can use it for other reasons and it'll grow tax-free. It's awesome. But the most you can only contribute into it is $35,000. But once it's in there, it can grow indefinitely. And if you get a student in there that didn't need this money and want to put it into their name, like a child or a grandchild's name, and they had even $35,000 in there, make believe that that's the number that was in there. It could be less, of course, but if it was $35,000 that they didn't need anymore, and they're in their 20s, and they invest it wisely, that money can double depending on how the market does, but typically every 10 to 12 years. So if you get a child that's 22, 32, 42, 52, 62, that thing can go double in size potentially by the time they retire in 65, 4 times. You do the math there. 35 goes to 70, 70 goes to 140, 140 goes to 280. So you thought that your little bit of money you may have put in there, which may be a lot of money to you today, it's going to be huge for them later on in life. And they can use it at any time because it's going to be in a Roth. So this is very interesting information because people previously didn't put a lot of money into these 529 plans. So now they don't have to worry about too much being stuck there and only be able to take out for educational purposes. And maybe then be able to use for their first house or a car or for, or pass it on to their children's college education. It creates some opportunities. So this is a great small but powerful long-term benefit. You go to the next slide unless anybody has any questions. Okay. Currently working. This is just a quick snapshot. Increased 401k plan and simple IRA catch-up contributions beginning in 2025. I think I alluded to this a little while ago. So people in a 401k plan will be able to go from 7,500 to 11,250, and it's based on what your age is. So participants still in the ages of 60 to 63 be able to put up to that much, and in a simple IRA, if they're still working, it gets increased by $1,750 as well. So if you're approaching retirement, this can increase your contributions until you're age 66. So this can help some people throw in an extra 10, 20, $1,000 over a short period of time, for periods while they're in the 60s. Next slide. Okay, here's some things that the Act did not change. And a lot of people have been talking about all these things. The backdoor Roth IRA strategy, where you put in money into an IRA if you're working, and then immediately convert it to a Roth IRA strategy. That's still available. A lot of people thought that when they raised the age on when you have to start taking money out of your IRA, they thought it was the same age that you're able to start doing QCDs. It's not. The qualified charitable distributions are still at age 70 and a half years old, which means that once you reach that age in a tax year, you're able to start taking money out of your IRA directly and sending it to charities and reduce your taxes. So some of you may or may not realize this. So let's make believe that you are 70 and a half or older, and you have a required minimum distribution already started. Forget the fact that it's raised now to 73. And let's make believe that that required minimum distribution is $30,000 a year. If you wanted to give away $10,000 or less or more, but whatever you take out and directly send to the charities from your IRA, that amount gets reduced on your tax return. So if you were not doing this and you just took out money and then wrote checks out to charities, you'd be taxed on a full $20,000 or $30,000 that you're required to take out. What this does is say, if you have it sent out directly to the charity, then it reduces your taxable income by the amount that you give to charities dollar for dollar. That can save you a tremendous amount of money depending on what your tax bracket is in. So don't be bashful about this. It could be $500 or $1,000. Why pay tax and then give money to the charity? This way you can take money out of your IRA directly, then only pay tax on the remaining balance that you're required to take out. That's very important. The Act did not change the limits on IRA conversions. They're unlimited. You can do as much as you want. There's no income limitation, okay? Whether you want to do 10,000 or 100,000, it doesn't matter. You can do as much as you want if you want to pay the tax, keep in mind, because you're taking out of a taxable account. And then distributions of IRAs or 4Ks with excess accumulations. That means that if you took out the distributions on excess accumulations, there's penalties. If you've accumulated too much money in these accounts by contributing more than what you were supposed to internally. So your CPA should make you aware of that. You should get those excess contributions out in a timely manner because there's like a 6% penalty on that. Let's go to the next page.
There's a question, John.
Sure.
If I want to wait to roll over my IRA to a Roth, once I am in a lower tax bracket, is there a max that can be rolled over? I think you pretty much said
No, that's what I was just saying.
Okay,
The Roth
yeah,
conversions are unlimited. Unlimited.
Let me just ask you, I actually need a clarification because people are coming to us for these legacy IRAs. So you're saying the QCD is 70 and a half, even though the RMD is 73 now?
Right.
So if they wanted to do a legacy IRA, then they could do that at 70 and a half,
Yes.
even, okay.
Yeah, the new age, first of all, if anybody in the phone call right now already had turned 72 last year, they had to take a required minimum distribution out last year.
Right, right.
If they are age 71 right now, for example, and they thought they were going to turn, they were going to turn 72 this year, okay, they don't have to take it out now because they raised it to 73. So they can wait until age next year when they turn 73. Next year when it turns 73 and have to take it out by the end of next year or even by April 15th of the following year. I usually don't recommend that people try to double up in that first year they're required to do it because it usually forces them into a higher tax bracket typically. So it's usually best, but everybody's facts and circumstances may be unique, but usually take out your required minimum distribution in the year you turn 73 now going forward. But in terms of taking money out of your IRAs, even before you're required to having to start take it, you now have a 2.5-year window. So at 70 and a half, you can start reducing your taxes on your tax return. Okay. So it's still beneficial because it will reduce the taxes that you'll have to pay later on when you're required to take them out.
Hmm.
So let's make believe you turn 70 and a half this
Right.
year. Okay. Not 73, 70 and a half. You're able to take out whatever you want as a QCD. It's not going to reduce your taxes because if you didn't take out any other IRA money out of there, there's nothing to reduce. But what it will do is it will reduce the amount that you will have to pay later because you didn't let it build up in your retirement account.
Right.
Okay.
See, I always thought the RMD and the QCD went together. So now with this new legislation, I'm finding out that it doesn't.
Yeah.
Like you said, it's not the same. Okay.
Yeah. And
Yeah.
people should be looking at this in terms of taxes and also their investments. and I can't get into that today, we could talk about that another time, is what types of investments should be in what types of accounts. Taxable accounts, retirement accounts, and Roth accounts. You should probably put, in general, more bonds or interest-bearing investments in retirement accounts. You should put the stocks or equities in taxable accounts, and pretty much 100% in your Roths, because they have the chance to make the most money over time and pay the least amount of tax because of lower capital gain rates, long-term capital gain rates.
And please share your feedback. I mean, anything that John is talking about that we don't have time, to expand on it, please send me an email, because we can always set up another power hour. Thanks.
Listen, my parents only started listening to me after I was out of school about 5 or 10 years. Now I got about 15, 20 years after that I've been working on this. They finally listened to me after a while. I probably would have had a much bigger inheritance if they listened to me earlier. But I told them to give it all to my brother. Don't worry. Anyway, let's go over some tax tips now for filing in 2022. Timing. If any of you are getting brokerage statements from your custodians like Fidelity, TD Ameritrade, Schwab, wherever you have your money, okay? Wait until mid-March, because a lot of times they correct these things to file. However, you should ask your tax preparer, because if you get a preliminary statement, your tax preparer may still want to give it to you, and then just make a couple of slight adjustments to it when you tell them that you're going to have a update coming. And a lot of times the custodians let you know that that's going to be happening in the next 2 weeks, 3 weeks, or 4 weeks. Because if you go in and they file the tax return and you don't let them know that there's going to be an amendment, they may charge you extra. And quite frankly, it just aggravates the tax preparer, which I used to sit in that seat many years ago, to have to redo it and change it. An amendment just takes extra work. So just make your preparer aware of it, or if they're good with it, wait until at least mid-March when most amendments are finished. Just general advice. Security. I have had a number of clients, and I have instructed them over the last 10 years to try to do things to minimize the chance of identity theft or fraudulent activity with their credit, okay? One thing is to try to freeze your credit by going to the 3 credit bureaus, TransUnion, Equifax, and Experian. And you can just go online, look up their numbers, you can call them up, and you can freeze your account. Each of them will give you a username and a PIN, so that if you want to unfreeze it, you can. Most retirees, they've already got a house, so they don't have to worry about looking for a loan for a house. Most of the times they don't want to get any more credit cards, so that's not the issue. A lot of times the only reason they're getting their credit check going forward is because maybe they get, not recently, but maybe up until about 6 months ago, had great financing, for example, on cars, for example. If it's 0% financing, they're still going to run your credit, and you may have to unfreeze your credit. But for the most part, it saves a lot of aggravation from trying to fix your credit if it's been compromised. So one of the things to do for tax reporting purposes, so your Social Security number is now floating out there, is obtain a protection identification number, which is 6 digits, and it helps you prevent cyber criminals from stealing your identity. Just be proactive. Go online and you can type in IRS PIN application and it will come up. I did it myself, okay? And it takes you about 15 minutes. That's it. And they will issue you a PIN. So when you go and file your tax return, you will no longer then be using your Social Security number. You'll be using this PIN. It's one less chance of somebody stealing your identity. I recommend it to everybody. Okay? Any questions? Okay, let's go to the next slide. Okay, carrying along here, non-deductible IRA contributions. This confuses a lot of people. While you were working, okay, you may have made some non-deductible IRA contributions, or even not, so you didn't get a deduction then. but it went into your IRA. If you didn't open up a separate IRA that only held your non-deductible portion, okay, it's going to be mixed with your tax-deductible IRA contributions. And that represents a percentage of it that you don't want to have taxed again if you already have paid the tax on it, and now it's just growing tax deferred. So there is a form called Form 8606. If you do your own taxes, you may miss this or not be aware of it. But if your CPA is aware of it and they're asking good questions like I do or did, okay, I did, is that you ask your clients if they have any portions of their IRA that you didn't use for a tax deduction, they were after taxes. And if it is, you need to fill out this form. However, it's your responsibility, not the IRS's or the custodian, to keep track of this and give it to your CPA and let them keep up on it. And then every year this needs to be filed until your IRA is fully distributed out. And if you never fully distribute it out, there's always going to be a percent that has to be filed on an annual basis, so that when you're taking money out, not all of it is taxed. So if you don't keep track of it, you're going to wind up paying tax twice on this amount. So it's just something to be aware of. I just wanted to bring it up. I see it happen from time to time. Next, report QCDs or pay on full RMD. I'll give you a perfect example. We help out our clients every single year with the distributions, get things out to the charities. They give us a list of who they want. We try to get it done earlier in the year opposed to later in the year. A lot of people do this in December. I try to get people to do it in January because your qualified charitable distributions are technically supposed to come out before you take your RMDs, the rest of it, okay? Or if you, if you exceed your RMDs, the QCDs, qualified charitable distributions, the checks that go directly from your IRA to these charities have to come out first before you get past your RMD. Some people need, for example, $40,000 to live on out of their IRAs, but their required minimum distribution may only be 30. You need to take out your qualified charitable distributions out before you reach the 30, because if you do it afterwards, you're not allowed to take it as a QCD. Okay, so the timing is important. Qualified charitable distributions have to come out before you get past your required minimum distribution. Now, when you go to file your tax return, okay, you get a 1099-R from the custodian who holds your IRA. When you get that 1099, it's only going to tell the IRS and your accountant or yourself, if you're preparing your tax return, the full amount that came out of there, without regard to you giving anything to charities directly out of the IRA. So you have to keep track of how much you're paying out to these qualified charities directly. Now, if you're working with a firm like mine, we do it for our clients and we make sure that all these things go out. They give us a list, we send them out directly, whether it's monthly, quarterly, or once a year, okay? Then we prepare a letter and we send it directly to their accountant or the CPA, in addition to the client, in case the client forgets to give it to their CPA, okay? To make sure that the accountant, or the tax preparer, deducts this from the total amount so you don't pay tax on the full amount. I cannot tell you how many amended returns there have been because the client didn't do that. So we started just sending things out directly to their accountants for them to make it a lot easier. Okay, so keep track of the things that you write. Now, some of you want to do this on your own. You can write checks, but it has to be a checkbook from your IRA. It can't be your personal checking account. But to avoid all those kind of issues, I would usually work with the custodian who holds your IRA or your financial advisor and let them do it directly, and they'll save you the time and aggravation of making a mistake. Any questions?
Yes, it's Brenda Ellis. And I have a question, is there a cap on how much that you can contribute to QCD? For instance, I had a 70,000 K RMD, and I contributed the complete 70,000 to the QCD.
That's right. You can-
Okay, so so there's not a cap amount. Is there a capped amount in which I can contribute? Or does that mean that you can only, if you use one QCD, that you can only contribute up to 50K to only one?
No, let me distinguish a couple of things.
Okay, thank you.
Sure. The whole purpose of a qualified charitable distribution, the main reason for that is to reduce your taxes to the extent that you're charitably inclined. You, my young lady, if you're giving QCDs, okay, and you're giving the full amount, you're saying, I don't need any of it. So you're allowed to get a tax benefit or QCD up to the amount of required minimum distribution to get the tax benefit. So that is your limit for purposes of saving on taxes. You can give more money out of your IRA if you want. It just won't save you any more taxes in that particular year. So
Okay, okay, and that's what I did. It was the max, so thank you very much.
Oh, you're welcome. You're welcome. Can you go to the next slide?
John, just real quick, I think you answered this, but I just want to make sure that the questions get answered. For the non-deductible IRA contribution,
Excuse
I
me,
receive
can
a
you go back
statement
one
from
slide,
Fidelity.
then? One slide, go back one.
Sorry, I receive a statement from
ahead.
Fidelity and I have both Roth and non-Roth, but Fidelity does not break them out. Is that what you're referring to, that it's up to her to manage that?
Wait, say it again. Fidelity.
Okay, for the
is our
non-deductible
state.
IRA contribution, I receive a statement from Fidelity and I have both Roth and non-Roth, but Fidelity does not break them out. Is that what you were referring to? She said, I believe you just answered my question. It's on me to manage.
Yes, it's your responsibility to keep track of that. That's correct.
Okay. All right, thank you.
Yes. Let's go to the next slide. Okay, these are some final kind of tax tips here. Filing Form 5500 requirement. So just to be clear here, this is for working people. So if you're retired, you can ignore this, but I'll just tell you this. Business owners with a solo 401k plan, solo 401k plans are like a husband or a wife or an individual has a business and they don't have any other employees. They can keep the cost of administration down by opening up a solo 401k plan. And just as long as the assets are under $250,000, they don't have to do anything. Just they get the deduction and they do it. If they have assets that have accumulated over the years of $250,000 or more, they're required to file Form 5500. Well, guess what happens? A lot of these single people trying to save money and not using a CPA or somebody who understands all this, and they get past this dollar amount and they get hit with fines for not filing this thing. And it can be exorbitant. So I'm just making you aware, if you have a son or a daughter and they got a small business and they're in it by themselves, let them know that they should, confirm if they have a solo 401k plan, just solo, just what it means, themselves or their wife or husband for that matter, either way, they have to file a Form 5500. And all it is a disclosure document with the IRS. So if it doesn't apply to any of you, that's fine. Report your state's portion of your municipal bond interest income for state tax exemption. Okay. A lot of people don't want to look at all the details, and this can get a little bit involved if you don't look at your 1099s. Some of you may have municipal bond fund interest income that you have in your taxable account, trying to reduce your federal taxes. But if you're in the state of New York and you actually have a New York municipal bond fund, 100% of that is not taxed on your state tax return as well. But a lot of times what people do is they get municipal bond funds that have multiple states where these municipalities are, and only a portion of it is in the state that they're in. They're only allowed to deduct on the state, so they don't have to pay taxes on it, the state's municipal bond interest on that. So it's non-deductible for federal, for everybody, municipal bond interest, but the states will only take off the amount that relate to the municipal bonds are earned in their state on a bond for their state. So this is in the little details. The fonts on these things are not exactly huge. It's not always easy to find, but there's usually a one-page or a two-page sheet that goes through all of the states that it's invested in And that percentage, if it was like, for argument's sake, 6% of the municipal bond interest in New York State, in a municipal bond fund that had multiple states there, and it was 6%, you'd get 6% of the $1,000. You wouldn't have to pay tax on the $60 of that $1,000, but you'd have to pay tax on the remaining balance, the $940. Okay, so it's tedious stuff to look at, but if the numbers get very large, and I have clients who have very large municipal bond funds, it's better to do that. You say, well, why wouldn't you just buy a municipal bond fund in my state? Well, for example, for people who lived in Illinois, their municipal bonds defaulted a lot. So a lot of times they bought municipal bonds outside of their own state. They got no state tax deduction, but they didn't pay federal, and it made sense, and they got no tax benefit. But when you're in New York State, a lot of times to diversify your holdings in different states so you don't put all your eggs in one basket, there's multiple states that are inside these municipal bond funds, and you have to look up your percentage that's deductible for your state income tax filing. Sorry, that was long-winded, but I wanted to give you the big picture. Okay, and don't forget to wait for your K1s for alternative investments. So like if you have an investment in a real estate investment trust, they're notorious for filing late, and you typically don't get your K1 until at the earliest after March 15th. So sometimes people forget about these things, and then they send it into to their tax preparer, or they file it themselves, and then they get their K1, which they forget about, and they have to file an amended return, and it's just extra work for no reason. So be patient and do that, and just make sure that you are, if you're doing your own taxes or you're having somebody else, that they do an estimate for you on where you might be for the upcoming year. And then you either have estimated payments being paid in timely, which are due in April, June, September, and January 1st for a tax year, okay? Now, you may not have to make those estimated payments if you already have taxes withheld from either Social Security or your pensions, or if you're still working from a W-2. So K1s, though, are related to additional income, like for REITs and other, maybe you have a company or some other company that you're invested in. I have one company that inherited her father's Green Line bus company from New York, and she waits every year, and she's always like, I'm never going to be able to file on time. I said, well, then you need to get out of this investment, or that's what you're, succumbing to. So those are some of the tax filing tips I wanted to make people aware of. Does anybody have any questions?
All I have to say is, thank God you're retired when you have to do all of this, because it sounds like a full-time job.
Sometimes it feels that way.
Oh, wow. It can get really confusing. Thank God we have people like you that can, guide us, because it is a little confusing. And I find even in gift planning, when they keep changing the rules, like with this RMD, people are like 73, and then, then it's going to go to 75. I'm like, I'm not even going to talk about that yet. They'll just keep this year, because again, the presidents and changing sometimes, they change the rules too. So you never know what's going to happen down the road, right?
Did Brenda have a question? Her hand's still up here on the screen.
I don't know. Yeah, we answered the one question, but I don't know.
Okay.
Brenda, do you have another question for us? I don't think so. What about Steve? I know he always has lots of questions. Any questions before we end our session? Anybody?
Well, let's go to the next slide, see if there was anything left here.
Okay.
Oh,
You
anyway.
had mentioned earlier that you were going to provide your email address. Will you be sending it via the email that was communicated with us, or just on the screen?
We can do it both ways, Susan.
We do it both. John, I
Okay.
have it. I think you have one.
Okay.
Yes, thanks, Brenda. That was a good question.
Yeah.
We'll definitely
At the end of the day, when you're trying to get good advice, regardless of who you use,
Right.
I mean, I am not on this to pick up a client today, unless you want to become a client. I mean, there's no sales pitch, no anything. I just want to make sure that people have the best advice and they're working with qualified people.
Right.
At the end of the day, if you have investments, which in your retirement ages are the biggest reason that you have taxes, right? It's no longer W-2 income. So it's either interest, it's dividends, it's your pension, it's capital gains. It's maybe you have a rental property if you're still involved in that, okay? And then it's your Social Security. That's what most people wind up having on your tax returns. And because they've limited the opportunity to take itemized deductions, the things that you can do are more limited to how to leave as much taxable income off of your tax return as you can. That doesn't mean not making the money. That means how it shows up and making sure that you could reduce your taxes now or in the future. So having somebody that understands how to design the investments so that minimizes it, but understands the tax consequences go hand in hand. You know, it's just one of those kind of things. They think you should talk to your investment person, then go talk to your tax person. The problem is most of the times these people are not communicating with you, and the only person who gets hurt is the client because they independently got advice without the two professionals talking. We make sure that the CPAs and we talk to them because as a CPA, I know their language and I know what it is. And that's where my frustration comes when I get a new client and the client goes to me, how come my CPA didn't tell me? How come my investment advisor didn't tell me? It's because they didn't get trained in the other discipline. And it's hard for them because, you know, they have no time during tax season to really get to know you. That's the frustrating part. And a lot of times I'll be very candid with you. Sometimes it's the client. They don't want to go back to the tax person after tax season and pay the extra $100 to get the best advice that'll be paying them for the rest of their lives. But I'm telling you, if you can find the right people to work with, they will give you peace of mind that you're doing everything you should and get all the tax benefits you can. That's what's most important. If you could just turn to the last page, I don't know if I have my email address on there. Yeah, here it is. If you want, all of you have a cell phone, and if you do, just to make it easy for yourself, take a picture of this. That's the easiest thing to do. I'm telling you, I keep forgetting to do that myself, you know? And if you want, as a courtesy, and I'm always, and Susan knows this as a fact, I have helped hundreds of some St. John's alumni in one way, shape, or form. I've been doing this for over 20 years. Susan got me involved. She snailed me in about like 20 something years ago. And it's become a more routine thing. I was just up there on Long Island in the end of October, and we did a presentation of alumni that were able to come. And it was really great for me personally because 3 or 4 of my classmates showed up. And it was a lot of fun. It was a lot of fun.
It was. That was great. We will definitely send a follow-up with the recording as well, because it is a lot of information. And even for myself, I'd like to go back and
and if you want my phone number, I'll just give it to you quick because I've got to jump myself. But my phone number is 352-228-1685. Susan can probably also send this to you. Yeah, it may take me a day to get back to you or something, or send me an email if you've got some specific questions, and I'll be glad to follow up. What's most important for Susan is for you to give her feedback, not so much about me. Maybe I'm a nice guy, maybe you don't like me, whatever. But what's most important is the information. If you found this stuff helpful, please let us know. And if you found things that made you raise questions about other things, let her know the types of things you'd like to hear about, because it doesn't have to be me, but she is always looking for the right speakers on the right topics.
No doubt about it. The other thing I just want to let everyone know, because I noticed one person is from Florida, from Tampa. I put a couple of links. We have the stjohns.edu/power hour. So we have power hours every month on a Tuesday at 1 o'clock. Then we have stjohns.edu/Florida. We're going to be down in Florida. I'm going to be down there March 2nd through March 14th. We'll be at West Palm, Orlando, the Villages, Tampa, Sarasota, Naples. We have the big Naples weekend, St. Patrick's Day weekend, and Bonita Springs. And then for all the alumni and our Women of St. John's, we have a wonderful lunch at the Garden City Hotel, March 26th. If you want to register, it is really, everybody is coming on board for this. So I would register early. It's stjohns.edu/celebrating women. So I hope you join us for other things. Please, like John said, give us your feedback, any additional topics that you're interested in. That's what we're here for. That's what's so great about being connected to St. John's. You know, you graduate, but we can still educate you after you graduate. So thanks again for spending your afternoon with us. And thanks, John, once again for sharing your expertise. So nice to see everyone. Have a great afternoon.
Thank you,
Bye-bye.
guys.
Bye-bye.
Bye.